To fight climate breakdown, Britain must get to zero carbon. Progress has been made already, but there is still a long way to go. So what could a greener future look like? And how might we get there? We're sharing our vision, which makes the most of the clean tech we already know works. Renewables. Here's how. By 2050, at least half of all households will have rooftop solar panels, and millions will store their renewable power for later use. Electric vehicles will support a smarter grid where people can play their part in generating, storing and sharing green energy. And gas boilers will be a thing of the past, with mass electrification of heat. This is just the start. Britain has everything it needs to become a renewable nation. Explore this bold vision for the future in our new report.
Okay, good morning everybody, and welcome to the launch of Renewable Nation. I'm Adam Forsyth, I'm Head of Research at Longspur Capital. Today we are launching Renewable Nation, Pathways to Zero Carbon Britain, which is a new report sponsored by Good Energy. The report shows that the UK can get to net zero with renewable energy. With the government's Climate Change Committee this morning saying that time is running out for realistic climate commitments, the report is very timely and very helpful. Longspur and Radnor have also this morning launched the active Net Zero Clean Energy Index and Universe. This is for companies that are enablers of the energy transition. I'm very happy to announce that Good Energy will be an inaugural constituent of the universe. Copies of the Renewable Nation report will be emailed to everyone attending after the presentation. This will be a recorded event. In a moment, Juliet Davenport, Chair of Good Energy, will present the report. Then we'll have a question and answer session with our panel. Please use the Q&A button at the bottom of the screen if you'd like to ask a question. Just to introduce the panel we have with us today, we have Guy Newey, who's from Energy Systems Catapult, who are the authors of the report. We also have Jonathan Waghorn, manager of the Guinness Global Energy Fund and the Guinness Sustainable Energy Fund. Mark Lacey, head of Commodities at Schroders, and Rhys, Petheram, head of Environmental Solutions at Jupiter. I'd now like to pass over to Juliet, who will share her presentation with you. Thank you, Juliet.
Adam, thank you so much, and good morning, everybody. First of all, Adam, I am not the chair of Good Energy. I like the fact that you promoted it. I am the chair of the subsidiary ZapMap, and I do sit on the board of Good Energy. And obviously, I'm the founder of Good Energy. Yes. So thank you so much for that intro, and thank you for helping us put on this event today. This report was something that we started work on last year. And actually, what it was really to look at a situation which was powered primarily by renewables. So we wanted to answer the question, so many times there is an assumption about what technologies are needed. So you need gas as a transition fuel. Is hydrogen the only way forward? Do we have to build more nuclear? And really what we did this report was we talked to various different organizations, but decided to work with Energy Systems Catapult as sort of one of the most competent sort of energy modelers, technology energy modelers in the UK, to really press the buttons on the UK system and understand, okay, so we have the most renewables resource in Europe. We have significant tidal, significant offshore wind, geothermal, and solar. So if we have all those resources, what would happen if we tried to use them all? And this is what this report tries to do. It tries to look at, okay, so what does that mean from the point of view of enabling technologies like carbon capture and storage, hydrogen, battery technology, heat pumps, and new investment in innovation. So if we go to the next slide. So the overall approach, many times when people ask us, how are we going to get to net zero? One of the things that we start to talk about is the fact that this is not just a single technology answer or a single policy answer. You actually need to look across the whole marketplace. So first of all, research and innovation, the work that's going into research and innovation today will really impact technologies that are going to come out in 5-10 years time and be part of this journey. Infrastructure, the infrastructure in the UK was built, and in most of Western Europe, built with high carbon technologies in mind. So centralized grid systems, the electricity, the gas grid, and the transport system will all need to adapt to the zero carbon world. The regulation was put in place to deal with basically primarily a gas powered electricity system and a gas heating system. Obviously, if we're going to zero carbon, the regulation is likely to change because the technologies will change. And what is becoming apparent and has really come out, I think the CCC report, Climate Change Committee report, called it out about a year ago, is how important the end consumer is going to be. Because what happens from the demand side is going to be key in terms of what you can deliver from the supply side. And finally, we don't really get into it in the report, but we know that as a result, there is going to need a change of skill set and capability and investment by government in that area. So that's kind of the lens we looked at this through. And so I would say we kind of considered the first 4 areas of these pillars in terms of the way that we looked at this report. Can we go to the next slide, please? So the report is, how can this be, the report looks at how can we solve zero carbon with a primarily renewable led approach. And one of the things that we wanted to look at, because energy models tend to do 2 key things. One, they have a bias in assumptions. So a lot of the time, the existing dominant technologies tend to continue to exist in the way they're formulated. And you also need to look at the granularity of the models. They don't quite often take into account the impact of 2 technologies coming together. They're very good at looking singular technologies. And for example, if you combined wind and nuclear, you have a system that's really quite difficult to deal with. And that was one of the things that came out of this modeling. If we go to the next report, next page. So our approach in this piece of work was to work with the existing model and establish a baseline to net zero, which basically said, let's just run it, see what happens, see what the cost is, see what technologies come through, and then start to flex the model from there. So what we then did is, having got our baseline, we then looked at res to 11, as we call it. So that basically turn it up as hard as you can go. And what's really interesting is if you just do it with renewable energy, you have quite significant costs because of the variability. You actually have to have a significant overcapacity to deal with variability. We then looked at something called flex revolution, which is really about adding a huge amounts of flexibility to the system and understanding what that does. Now, obviously, that's not an insignificant cost, but it does give you a significant benefit. And you can see that we then ended up combining those 2 scenarios together. We did also look at a hydrogen economy. So what does hydrogen look up if you turn it up? One of the interesting things about that is because electrolysis is so expensive, what it tends to do in the modeling is go with blue hydrogen. So you basically never quite kick the fossil fuel habit. You stay with the CC, carbon capture and storage you still need off the back of it. And it's not until legislation insists that it becomes green that you switch that off. And then the last one, no unicorns. So I did point out to the team, this might be a bit misleading. What they meant by no unicorns was no mythical technologies. So so run the scenarios with technologies that don't, today there's a lot of technologies that are assumed later on that come through the model that don't completely exist yet, not at the costs that we can imagine. And so let's call that no mythical technologies. And so having looked at all those scenarios, one, res to 11 was expensive. Flex revolution delivered, but it was also expensive. H2 delivers just blue hydrogen, and no unicorns. If you don't have those mythical technologies, then its baseline becomes very expensive. So what we did was combine flex revolution and res to 11. And as you can imagine, what that ended up doing was significantly reducing the cost of res, and you bring in flex. And that was where we ended up with our Zero Carbon Britain report. So what does that mean? So the key findings of the report are that the energy system is fully decarbonised primarily through electricity. And I think this is a general theme that we know is coming forwards, although there's some competition on heat with hydrogen. Electricity does dominate across heat and transport in this scenario. The other piece that's really important is that people power is significant. So we need to make sure to get this scenario to work, you have to actually improve housing stock significantly. You have to look at improving energy efficiency, home storage and home generation. So households are putting less pressure on the system and can actually flex with the system much more effectively. We get to 98% of all electricity demand is met with renewable technologies. Wind and solar are dominant, but are also supported by marine and geothermal later on. Storage and flexibility are absolutely crucial. And to be honest, I think they're crucial for whatever scenario you look at, whether that's large battery, through to small scale, through to pump storage, all of that is going to be needed in terms of security of supply. And what we find is if we run flex with res turned up, you end up with a scenario that looks very similar in cost terms to the baseline scenario. We'll go into a bit more detail in terms of where those costs come through. Next page. So one of the key things, issues with variable technologies such as renewables, particularly wind and solar, is understanding the security of the system. And that's one of the things this model does. And Energy Systems Catapult do very well. They basically won't let you run a scenario unless it does meet their kind of stringent targets around the stress test. And so what we actually see is that one of the reasons why geothermal, tidal and wave do come in is because they provide a relatively flexible kind of base load. So although they're completely predictable, you can also shape them slightly, which really helps the overall system manage renewables. It also comes out that we don't need nuclear beyond Hinkley C. There needs to be grid scale storage and domestic storage and solar panels. And around 50% of homes and businesses are fitted with solar panels. So that's rooftop solar becomes incredibly important. And actually, I was running some of the figures on this yesterday. I mean, we're back to kind of 6 to 7% return on domestic households if you put solar panels in at a reasonable cost today. Next slide, please. So what does the mix look like? So offshore is really, really dominant, as you can see, and that is no surprise. We know that the North Sea and the surrounding, particularly with floating offshore wind coming through, that's a significant proportion of the UK's energy. Onshore wind is still important. Solar is actually more important in terms of the actual production. Domestic solar is still important. Tidal is a good slug, and geothermal are both good slugs. So you can see you get that kind of overall balance, but you need not just one technology, it's all of them that you need to bring in. And those two, tidal and geothermal and solar, are really important to balance off wind, because they give you either a base load or an alternative load to the wind power sites. Next slide, please. So when we look at heat, heat is mainly electrified because it's the cheapest and most effective way of decarbonisation. By 2030, 46% of heat demand is provided by electricity. So this is seen by rapid uptake in heat pumps, both domestic, but also large-scale heat pumps connected to district heating networks. And then sort of one of the things that we absolutely have to do is a greater retrofit measures in terms of energy efficiency to really dampen down those peak loads of the winter. That really helps significantly in comparison to the base loads piece. Now, hydrogen does have a role to play in heat, but it's relatively small comparative to the electricity side. And it's mainly aimed at the hard to heat areas, whether that's industrial heat or large scale sort of high temperature heats. Next slide, please. Next slide. Hello. Brilliant, thank you. And then electrification of transport. So nearly 90% of transport goes electric. I mean, I think we're already seeing the trends of that with the 2030 deadline set by government, and it's a rapid move towards that. That increases the total electricity demand by about 50% over what it is today. So not as much as a lot of people think it will be. Hydrogen still has a role, and so does liquid fuel, mainly in the areas of the hard to transport area. So whether that's freight or heavy transport and air. But one of the key things about the electricity side is that we absolutely need smart EV, because to avoid putting more stress into the system, we have to make sure effectively we hardwire into the system that batteries, car charging can be switched on and off really flexibly. Next slide, please. So that then comes through in the costs. So the costs, particularly on electricity generation, are lower than baseload. That's because we're deploying renewables, which are relatively cheap. Electrical storage is lower as well, because again, with renewables and combining the two together, you need less electrical storage and you need less backup under this scenario. And that's primarily because you're not bringing nuclear in. What we're going to have to invest in is our electricity network. So that's going to have to deal with much more decentralized electricity, and energy efficiency costs are significant. So this is about retrofitting existing housing stock. Gas networks are slightly up, but the rest of them are all very similar between the two scenarios. And then I think the final slide. So the 5 principles, and we go into much more detail in the report on what that looks like. But number 1 is do the known now. So that's taking cheap technologies like wind and solar and deploying them today. 2, that's unleashing people power. So that is paying attention to the housing stock, understanding what role it has to play in the energy system, and making sure that we support consumers to do something about it. 3, embrace diversity. This is not a one technology fits all. This is about embracing a huge range of technologies, whether that's on the user side or those on the supply side. This needs a range of technologies. Britain has significant resources in all of these areas. So this will actually significantly increase the capability of the UK using its own resources, not having to import oil and gas. And then the 5th one is that this is not about delivering to a point in time. This is about delivering beyond that point. When we get to 2050, it won't be just like, oh, we got there. It's going to be about perpetuating that zero carbon. So a lot of these technologies need to be thinking long term about how do you make sure you keep going zero carbon after that. Adam, that's it. Thank you very much for everybody for listening this morning. I don't know what slide we want to end up on, but yes, I'll turn it back to you, Adam. I think you're on mute.
Thank you very much, Juliet. That was perfect. The statistician George Box once said that all models are wrong, but some models are useful. I think it's clear that the analysis in this report is extremely useful. I think it's going to help inform policy and particularly investment decisions going forward. So we're going to open to questions now, and actually we had some initial questions coming in. But what I'd quite like firstly to do is to ask the panelists just to give their initial thoughts. So perhaps Guy, if you'd like to kick off with your initial thoughts on the report today.
Thanks, Adam. That's great presentation from Juliet, and lovely to see all the hours of work summarised in such a short, pithy way, which is always half the skill. So, first question: why do we do scenarios like this? So the first point to make is these are not predictions of what the future and trying to give the impression that this is some kind of perfect foresight. But the key thing you're trying to do when you do this kind of work, and we do a lot of this at the Catapult, looking at various different versions of the future, is what do you need to believe if you think that a particular scenario is credible, and therefore for people thinking about investment and innovation in the energy sector, therefore, you know, where should I be putting my money? Should I be thinking about new propositions in a particular area, etc. It kind of informs the bets that people make. It's an obvious point, but it's always important to stress, because otherwise we'll get into a debate about whether it should be, you know, 35.6 gigawatts of solar by 2022, and or whatever the right numbers are. So you know, what do you need to believe? And so. And what opportunities are therefore revealed if you find this scenario of the future credible? And as Juliet's kind of rolled over, the opportunities are absolutely huge, and indeed the challenge is huge. Not as the CCC set out today, not quite clear that the government is picking up the mantle in. So 150 gigawatts of wind by 2050, with offshore wind being this workhorse of the electricity system. I think, and I by the way, I think that's pretty central around all scenarios that we've done, even if you see a much bigger role for technologies like nuclear or CCUS. 210 gigawatts of solar, 34 gigawatts of marine, etc. Big role for district heating. It's kind of, as Juliet says, kind of unsexy technology in the UK context. Dare I say, friends at Davenport probably say something differently, but actually that's a really chunky bit of the answer in these scenarios. Obviously, huge challenge and opportunity for heat pumps. And energy efficiency measure and flexibility, etc. So those are the kind of tech plays, the tech opportunities. But I think there's a few things I just say to have in mind is that the technology is not going to be enough. And in order for you to believe that this scenario is credible, you've got to be thinking, right, who's going to be coming up with the consumer-facing propositions, business consumers and crucially domestic consumers that are going to make this stuff easy and work for consumers. So that's going to make it easy to install a heat pump in their home, that it's not going to have to be some kind of Grand Designs-esque epic journey. Equally, making sure energy efficiency works and you're going to get the feedback. The flexibility side is going to be all kind of going away in the background, and you're not going to be having to wake up at 3 o'clock in the morning to charge up to turn your EV charger on, etc. Companies that are going to be able to come up with those propositions that really work for consumers, and the retail side is going to be such a more important part of the energy industry, or even more important than it has been over the last 10 years. I think that will be a big kind of comparative advantage for companies that can do that and have good relationships with their consumers, etc. Secondly, the local context is going to become much more important. When you're talking about district heating, you're talking about other things like that, how that is actually, how planning can get in the way of that, and how it could enable that, I think will be really important. Again, totally missing part of our kind of policy framework. And the third point I'd say is, in order to unlock this very flexible system which this scenario has set out, you're going to need market signals working properly, much more granular market signals, all of those kind of issues, which it seems that Ofgem and BEIS are starting to grapple with, just responding to the technology. But at the moment, the technology is moving much faster. So again, companies that are going to be able to come up with propositions that are going to capture that value is an important step, but it's also going to have to be accompanied by some pretty fundamental market design questions in our view. So an incredibly exciting next 20, 30 years coming up, and indeed we've got to really get on with it over the next few years. But it's going to have to be that combination of market design, technology improvement, and crucially consumer propositions that are going to be very attractive and scalable. And that's one of the most exciting aspects of many of the innovators we work with, the Catapult, including of course Good Energy.
Great, thank you very much, Guy. Jonathan, would you like to give some initial thoughts on what you've heard so far?
I will, thank you. And good morning, everybody. Wow, big piece of work. Commend the authors on what they have achieved. It's a very, very complex topic for sure. So done a very, very good job there, well worked through. It's one where we see many countries making a pledge. It's easy to pledge, it's very difficult to deliver. As of the end of last year, about 70% of world carbon emissions now are linked to some sort of net zero emission pledge. China having its 2060 target is probably the most recent one that we could think about. The energy industry representing 80% of world carbon emissions, so energy's got to solve its problems. This is absolutely critical, and that's why we're here talking about this. So the transition here has been going on, for a number of years, but the big thing that's changed recently for us, as we see it, is economics, in that the supply now of the renewables is, in most places in the world, at the lower end, if not the bottom end of the cost spectrum. So that's very, very much where we're focusing. So for me, I guess I'm here on the panel to give insight as to how the market thinks about this, how the investment opportunities occur as a result of all of this, That's essentially what my day job is, to analyze this space, analyze companies. And we at Guinness build an investment fund of concentrated exposure to names within this area. We've been doing that since 2007 at Guinness. We've been running energy money since 1998. So this is my day job. What can I tell you by very, very brief comment? Wow, volatility is probably the key theme. We can see some very, very attractive high-level growth rates coming through in that report there. Lots of very, very high percentage per annum rates. Yeah, just a warning to everybody, the solar industry globally grew from 1 gigawatt of installations to 100 gigawatt of installations, in the period running up to about 2018. If you'd been invested in companies that were part of that growth, you pretty much would have lost all of your money. So growth in and of itself is just not good enough. It is about the economics, it is about the returns, it's about the margins, it's about picking companies carefully that can defend themselves and deliver the growth whilst looking after your shareholder equity as well. So turning those growth ideas, the policy commitments, into individual equity ideas is a big job. Now, sadly, there's not much exposure in UK equities to these themes. I look at this on a global basis. We don't have very much in the way of UK exposure within our product range at the current time. So globally, manufacturing, it kind of provides more opportunities. But as a summary, I would say the companies involved in this area, they are going to see earnings growth, which is going to be greater than the market on average on a 10, 20, 30-year view. I mean, these are long-term themes. Essentially, that should drive outperformance of those equities versus the market on a long-term 10, 20, 30-year view. It's a very exciting and interesting place to be. Pick carefully. Adam, back to you.
Great, thanks, Jonathan. I have to say I so much agree with you that it's never just demand. Making the demand case has always been easy in the clean energy world. It's the economics are critical. Thank you, Mark. Would you like to give an initial view?
Yeah, can you hear me, Adam?
Loud and clear.
Okay, I obviously second Jonathan's comments as well in terms of the work that's gone into the report. And I'm always very respectful of what Juliet has to say on the sector as well. But there's a couple of things. I mean, and I'll just tell everyone what I do as well. Bear in mind, I worked with Jonathan for many, many years. I run the Energy Transition Fund here at Schroders as well. So we're investing on this space globally. And I also second his thoughts in terms of UK's expertise and listed expertise in that space. It's really rather limited at the moment. And so the whole point of this panel was to actually provide some comments on the report itself. And I think the analysis is very well thought out, but I think, and be interested to see what Juliet thinks on this, I think the analysis of the 144 billion of capital expenditure sterling, I just don't think it's enough. And the reason I don't think it's enough is because of supply chain management, cost pressures, and Juliet picked up on this, is that we will have to basically do a lot of this domestically in-house, and basically we will have to provide a lot of this capability ourselves in the UK in order for this to work. So, last night you got the news in Xinjiang, basically, that child labour is basically forcing the US to restrict supply with regard to obviously those solar and wind industry component manufacturers and suppliers, because obviously of those horrible issues. If you restrict supply, you have to source elsewhere. Logistically, we're under massive constraints at the moment with regard to shipping containers availability. Steel prices are starting to basically have a huge impact on this entire supply chain as well. All these issues have occurred in the previous decade, 2007, 2008. They're occurring right now. They will occur over the next 3 decades, whether it's once, twice, or 3 times over that period. So in order for the UK to do this, they will need to spend a lot of money on infrastructure, but also infrastructure in terms of capability in providing this. So, I've read the report in detail, as you'd expect me to do, but that's the one takeaway first that I would basically add. The second takeaway is it needs to be a looped, sustainable manufacturing process. If we, for example, invest in battery manufacturing capability, we also have to invest in battery recycling. EVs are not sustainable if we don't have some sort of recycling, whether it's pyrometallurgy or hydrometallurgy or even direct recycling. that has to come into play. That will come into play across other parts of the industry as well, with regard to obviously solar panels as well. So I'm very conscious of other people's time, and I can talk about this in a lot more detail, but I'm just going to say those are the two main takeaways from the report that I want to try and just have some comments on. But thank you.
Thank you, Mark. Really interesting, really helpful. And then Rhys, would you like to give us your initial thoughts?
Sure, thanks, Adam, and thanks, Juliet and Guy and the team for publishing the report. It's a really useful contribution and certainly helpful as investors and as we attempt to tackle this space. But perhaps as a quick introduction, and excuse my voice, I seem to have almost lost it overnight. I'm a fixed income fund manager. I'm head of environmental solutions at Jupiter, where our team run a series of environmental thematic funds across listed fixed income as well as listed equity space. So I run the fixed income multi-asset ecology diversified fund, while my equity colleagues manage the Green Investment Trust and the long-standing ecology equity fund, which was launched over 30 years ago now. And it's with that perspective, I suppose, across the capital structure that the first thing that comes to my mind when reading the report is how is this going to be financed? And do we have the right products, and where are the right investment opportunities? And when I say how is it going to be financed, I'm not really talking about the quantity of capital. Actually, that's not really a problem at this point in time. There's a lot of capital going around. Instead, it's really the quality of capital and the right type of capital that suits the needs of activities, which really require quite different financing structures when you look across the various activities that Juliet's highlighted. So, for example, in fixed income market, we've seen lots of innovation over the last few years. You've got now an alphabet soup of different types of instruments, from SLBs to sustainability linked bonds to green bonds to transition bonds, social bonds, and so on. Some of these are going to be really helpful, and some of them are going to be completely ineffective in supporting change. So the market needs to continue to evolve. Harmonization and standardization of standards when thinking about these instruments need to evolve, as well as certification to ensure we're investing in an effective way. Those are the things that really come to mind. And I think actually the expertise also needs to continue to evolve across the investment market. It's certainly fixed income has been completely transformed over the last few years as far as the amount of expertise in this area. 10 years ago, when the first green bonds came along, it was myself and a couple of sustainability analysts sort of talking to the companies about their green bonds. Now the room is packed with people who can speak the same language. So a lot of optimism there. I also think perhaps the market needs to shift a little bit now when we think about ESG and sustainability from one of, we've sort of had this journey of SRI, so thinking about the social impact, to ESG, which is very much about the risk framework. We need to now move to transforming the whole system, to really thinking about the economic activities and how do we support, as investors, those economic activities that create change. So how do we support those enablers of change? A second observation, I suppose, that I make is, and it sort of relates a little bit to what Mark was saying on, really is that the model has been done on a UK basis for a global problem, and there's strengths in having a UK perspective, but also there's a few weaknesses come along with that, simply because the actions of one nation impacts those of another, and how you can implement your strategies. And I think there's two big things that come from that. One is emerging market investing. So the cost of reducing a ton of carbon in emerging markets is half that of what it costs in developed markets. So ensuring that the capital is available and being implemented in those regions is critically important, because we all have to be on this journey together. And then secondly, it relates to a growing theme around circular economy, and just the extreme strain on global resources that these kind of pathways imply. If you take EVs alone, they require 5 times the amount of copper than an internal combustion engine, for example. There's lots of great stats out there about these the amount of resources involved. So I think this theme around circular economy is certainly something that needs to evolve. And it will evolve, I think, because the climate change is not the only big risk out there. So natural capital depletion and biodiversity risks are big growing themes within the markets. And in my view, in the next few years, will garner just as much attention as climate change. And these risks are inextricably linked. So natural capital, the forests, the oceans, they act as carbon sinks. They play a role in climate change mitigation, but they also face a real risk from climate change itself. So I think for me, a big theme over the next 12 months or so will be more around this circular economy theme.
Great, thank you very much, Rhys. I think we're hearing from the panelists quite a bit around spend not being enough. Mark, probably going to spend more. Issues about how that gets financed. And some of the questions very much alluding to that. So maybe the first one really, in terms of the costs of change, what assumptions should we be thinking about in terms of relating that to subsidies, grants, and tax? So essentially, that sort of wider regulatory angle towards the cost of delivering a net zero outcome.
Adam, do you want me to try and answer that? I'm actually probably going to bring Guy in on this as well, because he knows probably as much about this as I do. But I mean, in terms of, obviously we saw the Green Homes grant, which was pulled fairly quickly by government over the winter. I mean, it was taken up with glee by householders. So I think if you can put the right kind of structure around household investment, and I do see that there is a need for more instruments for households to make these kind of investments and to allow that. We saw under the original feed-in tariff, where we saw rooftop solar develop significantly, one of the areas that Good worked with specifically was social housing organizations who would roll out 2,000 solar rooftops in one go. And obviously financing that as a package became much easier. They did it, they had the feed-in tariff to support. But I think we need to look further now in terms of what are the mechanisms to be able to get finance down at that level. And what I think one of the things that was coming through, what are the propositions from companies that can actually help to do that? Because that's where we need to be deploying capital, is at that domestic level, at that retail level, essentially. Guy, I don't know whether you want to add to that.
Yeah. So I think that's right. Just from a pure modelling technical point of view, the model is largely policy neutral as such, because you're trying to understand the technology. There will be things in there which are kind of baked into the sound, like the 2025 coal closure or etc., which are working. But largely you're trying to understand the different measures, which of course then leads you to what policy measures are you going to have to encourage the kind of deployment. Because I was very struck by Mark's point about the capital question and actually how much this is going to be, because you've got two competing pressures. You've seen some extraordinary innovations which have brought down the kind of overall cost of capital, and certainly that was I guess beat the consensus view, certainly in technologies like offshore wind and solar. But absolutely, if you think about this, has got to be done not just in the UK context, but this extraordinary transformation we describe in this report has to be done everywhere across the world. Those are, the opportunity is just enormous, but absolutely is going to put pressure on supply chain, and you're going to get, knocked sideways by interventions like Xinjiang, as Mark said. So I think, whilst we've worked very hard to come up with the best assumptions to give you that number, the range is very significant. But it does come back to that point Juliet made about, right, well, what are the policy mechanisms which are going to think about what the right allocation of risk should be? Are they purely, this is purely a capital play, so we do absolutely everything to get the cost of capital down, and it's just deploy, or actually is it trying to get a balance in the market where more risk is taken by different market participants? And I think that's the fundamental question for government and policymakers to be kind of grappling with, which will give the signals to investment that we need to think about.
Yeah, I think, and actually taking Juliet's comments on things like the feed-in tariff, from an investor point of view, a very low risk energy stream, less than volatile, index linked, RPI linked. Jonathan, you made the comment about volatility. as being a key issue. And I'm not sure whether we're talking about share price volatility or volatility in underlying economics. And on that latter point, how do you see regulation evolving? How would you like to see it from an investor point of view? What's going to be most helpful?
Yeah, so my point on volatility was with respect to share prices. It's been very, very high indeed. With respect to regulation, I probably can't add a great deal in terms of how regulation should evolve, but I see this big picture terms very much as being kind of carrot and stick. So you've got the carrot, which is the various different subsidies that could be part of regulation to tempt people to move across. The stick side of it that we haven't discussed yet is carbon prices, and that's taxing out the existing. And that clearly is evolving very rapidly, but it still has an enormously long way to go. We all think of the European system as being sort of 50 euros a ton. That system is well out there on a global perspective. China's just added a system, but with next to no cost at the moment. If you take global carbon emissions and the revenues generated by ETSs, then the average carbon price is still less than $1 a ton. So that has a long way to go to transition as well, to push people away as much as seeing kind of the regulation tempting people to move across to new. I wanted to draw a few comparisons to a report by the IEA that they published just a few weeks ago, their net zero emissions for 2050. So on a global perspective, and within their scenario, which is, again, as they stress, only a scenario, they have to assume carbon prices go to $250 a ton in 2050 in developed markets. They go to $200 a ton in developing markets, including China, by 2050. So there's a dramatic push there towards the economics of fossil fuels moving in the wrong direction and tempting others to move over. And to the point just on investment that Mark brought up, completely concur. Investment in this, according to the IEA, anyway, on their numbers, currently the last 5 or 10 years, it's about $1 trillion per annum of investment into clean energy networks, generation, etc. They see that expanding to somewhere between $4 and $5 trillion per annum over that period. So there is a lot of money to be spent, and some of it will be horrendously stranded, I'm sure, and some very, very successful.
Just to take up your carrot and stick point, actually, it feeds in actually quite nicely to a couple of other questions being asked, and actually ties very much into the consumer angle here. So somebody's asking, how can consumers be incentivized to do their bit? And someone else has brought up the issue of how can flexible tariffs work, particularly in helping things like smart EV charging, getting people to charge at the right time. What do we think about that? Is that going to work? Will behaviour follow policy?
And I think it's quite interesting at the moment. So I think what you'll always get is you'll get early adopters in a market. So Good is launching an agile tariff. We're seeing other market participants with significant agile tariffs where essentially customers are being rewarded for turning power on and turning power off. This is kind of the first time we've seen consumers really engaged in this part of the market. Traditionally, the market has been disengaged. So most energy users, most people who use a train know that if you get on it at peak hours, it's more expensive. And if you get on off peak, it's less expensive. Nobody has a clue that between 5 and 7 in the winter months, power is kind of nearly 2 or 3 times more expensive to deliver than it is at any other time. So I think this is the kind of change and shift that we might be able to see consumers picking up on. And what's going to be really important is the technology that to roll that out at scale, you've got to see the technology that enables that, because most of us are not going to sit there on our mobile phones trading power. But you can already begin to see a system that could do that for you. And I think that is what we're beginning to see in infancy right now, but that's what's going to be needed for these marketplaces, whether it's the technology itself that becomes smart or whether it's the IT behind the technology and the digital offerings that become smart. I think those are going to be the cut-throughs. And obviously that's what we're trying to do at Good and experimenting with at the moment, is exactly how far and how much you can push that.
Actually, I wonder from the investors on the panel, if you see a more consumer-driven response rather than a policy-driven response as less risky from an investment point of view.
I'll jump in, guys. Don't worry. Yes, it's got to be all about consumers, hasn't it? I guess. And again, I'll hark back to the IEA report. They talk about 55% of the emissions that are being abated by 2050 coming from consumer behaviour. So that's actions such as purchasing an EV, retrofitting a house with energy efficiency, installing a heat pump, all of those kinds of things. The key point on the consumer for me is the consumer will react to what is in or not in his pocket. So it all comes down to individual personal economics. So making fossil fuels more expensive, making the choices towards lower carbon choices being that much more economic individually. That's really what it comes down to. And if we as investors can find companies that have hit that very nice seam of kind of consumer demand for a product that is clearly going to continue growing, that is not reliant upon subsidy, then that is a massive advantage. Go back to 2008, 2010, post-global financial crisis, we had enormous solar farms being developed in Spain on the back of government subsidies. And those subsidies were taken away and retroactively removed as well. And that was one of the main reasons why equities were so volatile over that period. So we as investors try as much as possible to avoid those companies that are reliant upon subsidies to make their businesses work. It's a necessary thing to get things going, but it's not necessarily long-term sustainable.
Yeah, I think you're on the way there, though, in terms of if you think about the EV market, because the EV is going to be used as a storage facility as well as basically just a car. So you're changing the consumer product. You've got battery prices at around $100 per kilowatt hour right now. That's come down from $1,200 a kilowatt hour in the time period that Jonathan's talking about, 2010. And $100 per kilowatt hour is actually the crossover with an internal combustion engine vehicle. So what's the next incentive for the take-up? Well, you speak to the battery companies and they can bring that cost profile down towards about $65 a kilowatt hour. It's about 45% of the overall vehicle costs. So that's going to really incentivize it, because your churn rate on vehicles in the UK, your replacement rate, is about 4% per annum without this structural shift. And at the same time, you've got Germany are introducing a carbon tax at the pump in 2025. So what you're doing is you're giving the heads up to the consumer that they're going to have increasing costs. You've got your input costs decreasing, so that will accelerate the take-up. But then there's a problem. If you adopt an electric vehicle, you effectively double your electricity consumption on an annual basis. So you need the infrastructure externally to basically to facilitate that. So the consumer is so important, but at the same time, you need the investment in infrastructure in order for this all to happen. Because otherwise, you just won't be able to keep up with that consumer change. It's a bit like the iPhone, basically.
Yeah, I think it has to be more of a balanced approach between government and consumer. Yeah. If you look at the IEA's, their main strapline from their recent report was that there would be no new oil investment beyond 2021. And the basis for that was that the demand simply wouldn't be there for the end product due to the big uptakes in EVs, which is driven on the one hand by regulation, but also by shifts in consumer behavior. So it has to be hand in hand, in my view. And I just don't think we're ready yet at the consumer level to take that leadership. If you look at Switzerland only last week, voting down a climate change law, yes, it was close, 49, 51%, but the leadership is just, it's not strong enough. It's not there. It still needs to come through. And maybe just a slight, just a quick follow-up to one of Juliet's points, actually, about the financing side at the consumer and the household level. This is critically important. I think this is one area that really does need to innovate more. You do see it in the US through their PACE program. So these are home renovation financing programs. It's a securitization market. In Europe, we all sort of ran for the hills from securitizations post the global financial crisis. The expertise still needs building up. The regulation around that area needs building up and supporting, because that's potentially a useful innovation when it comes to financing at the household level.
Just add a couple of bits of nuance to some of the stuff. beforehand. So I absolutely agree with Mark and Jonathan about the the EVs from a consumer point of view is looking attractive, prices are going to come down, etc. The key challenge is making sure the system can cope, including at a local level. I mean, it's we talked about national picture here, but making sure the LV network can cope with everyone in the street getting a Nissan Leaf at the same week and plugging in at the same time, etc. Which is again, people who can flatten that curve are going to be really important. I think the one nuance I'd put on it is that it's harder to see that really great consumer journey for heating in the UK yet. And I know the UK is a slightly unusual model, but that for me is all these scenarios and all this work always end up with whoever is going to come up with a really good heating offer, which is going to make it very easy for everyone to decarbonize their homes in a practical way, and we're going to have certain confidence that it's going to work really well and it's going to be a good consumer experience. Because I think I absolutely generally agree on the point of it's got to be cost effective, etc. But people will pay more to make sure that their heating is right, even if that's fossil fuels, right? Our workers say that 48% of people don't realize that their boilers are contributing to climate change. That's such a far journey we've got to get them on. So cost is definitely important. Of course, that's part of a factor, but people will not mess around with their heating if they're not confident that the alternative consumer proposition really works.
There's quite a lot of that coming through here. There's a balance that a lot required in infrastructure. We've had a couple of questions asking about the need for regulation potentially to change to encourage infrastructure investment. Related to that is how sustainable is infrastructure policy. Somebody's asked about what happens if Donald Trump came back into power. So every 5 years you can get major political change. From an investment point of view, how do we deal with that?
Do you want me to come in first, Adam, and then hand over maybe?
Yeah.
I mean, I think what's quite interesting on infrastructure is it does take a slightly longer term point of view. So even if you had a Trump in sort of for a period of time, if you assume that's a blip on the landscape, then it's unlikely they're going to be able to change infrastructure policy that quickly. There is quite an interesting review, and Guy can give you his view on it. My view, I think it's very welcome, is that the regulator is currently being challenged on whether they should have a zero carbon mandate. And obviously all the regulation related to whether the local distribution networks, the national networks, and all the codes that govern the way that we trade electricity are overseen by the regulator. Now, if they had a zero carbon mandate, which our view is that they should do, that would help in terms of keeping longevity and make sure that every single change, because there's a lot of small changes that go on in the system continually, that every single one of those change were thought through the lens, not just an economic lens, which is what they're currently looked at. They're looked at from a carbon point of view as well. And we think that that is necessary without a carbon tax that's effectively got any teeth. We think that's really necessary going forwards. Guy, I don't know whether you want to add to that.
Yeah, just on the Ofgem point, specifically off the regulated UK context, is I actually think there's been a kind of quite profound shift both at the board level and elsewhere to really think to take net zero seriously. I think having a mandate on top of that would kind of embed that even further right down the organisation. But I certainly think the leadership take their role in it seriously. Just a bit. I guess one of the questions is kind of about politics and longevity. And before I thought about innovation at the Catapult, I was a political advisor. So I've kind of lived the hard yards of this stuff, and we are in a kind of brilliant upswing. In fact, I'm quite jealous of people in government at the moment because there's a big consensus that we've got to do stuff on net zero right from the Prime Minister, which certainly wasn't the case when I was there. And we will still maintain largely a good cross-party consensus on climate change, which is part of why we've had some of the success, and that seems to hold pretty well. Not least because there's not, green issues are a kind of hygiene factor. So it would be very difficult to get elected in lots of seats if you didn't have, a significant offer on clean stuff, which is partly one of the reasons that the current Prime Minister has embraced it, as well as lots of other kind of cultural issues, as it were. So I'm reasonably confident on that, but my sense of the politics is it's wide support, but it's kind of slightly, if really pushed, and it always comes back to buildings. Like if people start messing out with their boilers and it seems as a bad experience, then the politics gets quite quickly, as we've seen in France, as we've seen in other countries. And you have to be saying this story. Sorry, I'll get into my political speech now. You have to be saying this story about why this stuff is going to be better for consumers. It's back to Jonathan's point. Yes, we want it to be cheaper, we want it to be better, your home's going to be better, it's going to be less draft and damps, all that stuff. That's the story you have to tell.
Yep. Good. Someone's asked about geothermal. I mean, they specifically asked that the role of geothermal in the report seems to be quite large, and they're wondering where in the UK that might be based. And I guess related to that, there aren't a lot of investment, well, certainly in the listed markets in the UK, there's not a lot of investment opportunities in geothermal. Juliet, if I've missed something that Good Energy have done, please shoot me down. But I wonder how technologies like geothermal can be invested in from the investor point of view. Given that, I mean, there's ORMAT internationally. Apart from that, I think that's probably one of the few sort of investment opportunities.
I think this is an emerging technology. I'm not sure it's something to invest in today, Adam. I think the key people who I've seen actually who did do a fundraise around this a while ago is the Eden project. Yep. So they're currently drilling to build a 10 megawatt power station, I think, next to the Eden project down. And I think is it a 2 kilometre drill?
I think that's right. They funded the down well, but not the up one, I think, which surprised me. But
I think they've got some innovation funding as well. I mean, I think obviously these early stage technologies are always difficult to invest in because, but we could see some of the capability that we've already got in this country from mining and from offshore really being able to cross across into this sector, because those are the key technologies that you're going to need and the key knowledge and know-how. And I think it does play into this skills piece. I think one of the things about the report is mapping out what the skill sets and the skill capabilities are that we're going to need across the board. I mean, for example, Guy's point on heat pumps and installing heat pumps, the more people who know how to install a heat pump, the better the experience for the consumer will be. And I think that is definitely, I had a heat pump installed 5 years ago. It was quite a complex installation, and my boiler room does look a little bit like a spaceship. I am assuming that there will be improvements as we go along, not only in the capability of those who come and install, not to say the guys didn't do a great job, but also in the technology itself, which hasn't seen a lot of innovation or change in terms of its actual practicality in terms of different consumer and in terms of the materials as well. So I think there is a massive role. The innovation strategy is being worked on as we speak at Bays. I do think there's a massive role for material innovation as well. And we touched on the amount of copper that's going to be needed. We kind of need innovation in mining as well. I mean, mining to date is basically scoop it out of the ground and see what's in there slightly. I mean, that's a little harsh, but not far off. The capability that we now have, whether it's from a geo capability of looking at the data and looking underneath and understanding how to manage mines more effectively, more cost effectively, but also without creating huge environmental and biodiversity loss. I think is going to be a key piece, and that's an area where we're going to have to see innovation coming forwards if we're going to meet the materials needs of these 2050 targets.
And actually, for the investors on the panel, has anybody invested in geothermal or see an opportunity for doing so?
You can get it in different ways. It's just like you can get hydrogen exposure in different ways through, for example, plastic omnium or forechia. You can get geothermal exposure, and this is probably going to make a few people cry on the call, but basically you can get it through the oilfield service company exposure. So Schlumberger and Wood Group, it's a small part, because as Juliet said, it's just in its infancy, but Wood Group engineering department obviously basically provide engineering solutions for geothermal. But it's tiny relative to their overall business mix at the moment. So, but Wood Group's the case in point, where the industry has to change at the same time. Wood Group provide more services now in renewables than they do in oil and gas in terms of overall revenue and EBITDA exposure. That's a company that has to change. I'm not quite, Juliet, sure that mining is about basically digging a big hole and guessing what you've got.
I'm being a little harsh.
I think so, yeah. I think the problem with mining, in particular, when you look at cobalt, which is obviously part of NCM makeup, and even parts of the copper industry, it's in very, very difficult places where the environment is not top of their minds. Actually, people's safety is not top of anyone's minds. That's the problem with the industry. It's in very, very difficult places, and the less reliance on those places or a better control of those places is really what's needed for this industry to really work.
Something that Juliet just touched on there, which I think is quite interesting, worth drawing out. We talk a lot about the supply chain in terms of materials, but in terms of skill sets and bringing through the right skills needed for the transition. I wonder if people have a view on that. I mean, at the moment we see this in the hydrogen economy, particularly hydrogen is a harder gas to work with than methane, and some of the skilling up and finding people with experience is quite hard. What do people think about skill shortages, particularly in the UK context? Because remember, this is a UK report.
I'm happy to comment on that. I mean, you know, the kind of the real pinch points at the moment, and we saw this with the Green Home Grant, is buildings, right? Finding somebody who can really do a good job on your home, and that's also the case for non-domestic buildings as well, which is something that doesn't get enough attention. People who can really think that through. I think that's very important. I think the point on hydrogen, etc. I mean, if you just look at some of these, the numbers in terms of the scale of these industries that have been created. I mean, the scenario here is actually a relatively low hydrogen scenario versus the baseline scenario, but it's still kind of 100 kind of terawatt hours of low carbon hydrogen going into the particularly hard to treat, you know, industrial processes, etc. And, you know, the entire hydrogen economy in the UK is about something like 27, 28 terawatt hours, and hardly any of that is low carbon, for example. So the transformation in skills across all elements of that supply chain are going to be huge. So, you know, back to Mark's point about pinch points, as it were, he talked about globally, but, you know, local supply chains is going to be massive. I mean, we should all be training to be engineers. I mean, I think that's encouraging all our kids and everyone we know to do that. That always seems to be the lesson for me.
But I moved into finance.
Do you think we could do engineering and Shakespeare? Kind of add the UK mix twist to it and make it more attractive.
I think that's right. Yeah, Adam, you're right. There's too many engineers in finance. Does that vacuum them all up? We need them working as you can get their spanners out again.
Hugh, Jonathan.
Yeah, as an engineer that works in finance, that's a nice little segue to me, I guess. But from thanks for that, Mark. From the point of view of people and skills, I don't know, particularly from a UK context, but I would imagine with the oil industry background that we have, the oil industry is used to dealing with, you know, gases and liquids at high pressures and high temperatures. That's essentially what the hydrogen economy is going to be about as well. So I would think the retraining of people from those areas into hydrogen and associated industrial processes, probably we stand a pretty good chance. I want to just add a couple of comments to some of the other things. Geothermal, absolutely right. Very little you can invest in, to be honest with you. So not much to add there. From the point of view of new technologies and reliance upon what's going to make all this happen, again, I hark back to that IEA report. 50% of the emissions being reduced in 2050, in their words, come from technologies that don't yet exist. So a lot of this is on a bit of a hope and a prayer, but with the expectation that technology curves continue. And then the third point actually was on the question that came through on regulatory risk. How can investors be comfortable with the regulatory risk? Well, I'm sorry, the answer is it's going to be very difficult to get confident and comfortable with the regulatory risk. It is a risk, it's a continuous risk. What I wanted to do is put that into context a little bit. If you look at sustainable equities, sustainable energy equities as an example, our fund's trading at a 10% earnings multiple, PE multiple to the market, to the stock market, okay? I mentioned earlier the earnings growth potential of sustainable energy companies. I think it's very impressive on a 10, 20, 30-year view. Is it 3% per annum of excess growth, or 4% or 5%? If you start to compound that kind of earnings growth over 10, 20 or 30-year periods, these equities should be trading at 50 to 100% premiums to the MSCI World. So if you were to believe that this is going to happen, no question, these equities should be trading at much higher multiples. They are not. That reflects clearly some of the various risks, and I think critical in that would be those regulatory risks. Adam.
Yeah, interesting. Juliet, you suggested that geothermal was maybe a bit early stage for mainstream investors. I wonder how the panel sees technology risk in that regard. I mean, there are some, what I would say, quite early stage, some quite techy companies in the market now, and some of those, you know, some of those are likely to be major contributors to the solution. They may be unicorns, of course, and therefore not covered as in the no unicorn scenario. But I wonder what's the view of investors to that kind of end of the investment, almost the investment line.
Maybe I can start with that, Adam, perhaps. I suppose one interesting lens that the green bond market brings is it sort of goes beyond corporates to the actual investment activities of organizations. So you get a bit of insight as to what technologies are actually gaining ground, and to the point on geothermal, actually we haven't really seen much at all, other than the obvious spots in Indonesia and so forth. But very limited actual investment activity in that regard. I think around 90% of the use of proceeds of green bonds still goes to clean energy buildings and commercial buildings and transport. But we do see areas such as green hydrogen starting to gain some ground, mainly from the sort of the industrial gases plays. And even early days on fuel cells, you're seeing a couple of deals in that regard. But it's still the bulk of heavy work is done by the bulk of projects, which Juliet's report highlights, really, those big sort of clean energy buildings and transport.
One other thing related to technology companies, which we see as certainly as listed in the UK markets, they tend to be quite small companies. And there's obviously a lot of investment come into this area generally and into the wider ESG space. But often that money ends up in funds which end up being too big to buy. You know, a £10 billion fund can't buy a £100 million company without buying the whole thing, which of course it's not allowed to do. I wonder if that's something the panel sees as an issue and something that needs solved.
No, the uncomfortable silence meant I thought I should say something, but no, I don't think it's an issue at all. You don't have to buy the whole company. Certainly the way we manage the strategy at Schroders is quite simply, we have core companies that are really well known, household names almost, but obviously we're running a returns profile on those companies. But the smaller innovative companies, you know, like Ilika, for example, in the battery space is what you're referring to, isn't it? You know, ITM, obviously on the hydrogen space. These companies need funding from the broader market. So we would take a much smaller stake and we would put them into effectively a basket, which we call incubator stocks or effectively, you know, future generation stocks. Now, these aren't unicorns. These are companies with proven technology, but they will have funding events at various stages where they need to come back to the market to basically enable that growth. If companies like Schroders or Guinness or Jupiter didn't exist, these companies wouldn't exist because the cost of capital in the equity market is a lot lower. So absolutely right. You know, we should be investing in these areas, particularly when they're as well managed as those companies that I've already mentioned, in order for them to basically get to that path and bring the cost profile down. Because that's how Vestas started out. It was an early stage investment and it's grown from there, and now it's a dominant provider in the turbine market.
Yeah, no, I'd concur with that. I mean, certainly when I look at our equity funds, green equity funds, we have dedicated baskets to innovators. And from a risk budgeting point of view, there are limits, you're right, but certainly as dedicated funds and the equity story is all about the growth. That's a key component to addressing it. I think if you're a big pension fund looking to invest in this space, it's important to have product out there that they can invest in, but they're going to be looking a bit more at the next stage, the accelerators. So the companies that have evolved from that innovation space to the next stage of acceleration.
Just a quick thing from, we work with a lot of companies in the kind of early stage innovation space, and helping them think about their business models and where their tech may be able to help out with this question. And the first thing to say, there are loads of companies in the UK context who are operating in various different bits of it, whether it's around smart grid, around batteries, or others. There's kind of a very healthy ecosystem, but there's a lot of tiddlers, and so the question and it also comes back to this policy regulatory question, right? Because they say, well, we go to investors and they say, well, where's your market? And they say, well, the market will be there if this regulation happens. And at that point, to Jonathan's point, everyone goes, well, then I'm betting on whether Ofgem or BEIS are going to get their act together, etc. So I think really giving confidence about what this market will come is probably the most important thing for the small companies that we work with, so they can see the value.
Right. Well, we're running out of time. Thank you very much for your comments. Would everybody like to give one final comment to wrap up? Juliet, we should start with you.
Yeah, I mean, Adam, thank you. And I mean, as I said, this report we really put out there to create food for thought and to really start to think through some of the implications of this type of approach. And also to see what emerging markets there might be, whether that's in residential finance for small scale renewables, through to kind of what does green hydrogen really look like and how big a role can it play. And also I think in terms of coming back to Guy's point is where are the innovations that we kind of need to see, and what are the emerging technologies and companies coming through in there. And for us, from our point of view, we're looking at this from a consumer point of view and understanding what are the propositions that consumers want, and therefore what are the technologies we either need to align with or organizations we need to partner with. And that's one of the reasons we ran the report, to really understand what the potential market is. But we think we hope it's useful as a kind of thought provoker as much as anything else. And actually, if you do get to read the detail of the report, the guys have done a brilliant job. There's some great pullouts and some really interesting insights in terms of why things are happening and why things aren't happening. So I recommend that people do read it. I really enjoyed it, despite the fact I know we commissioned it, but it was a good read. And we'll hope that it will at least provoke some real thinking around this area.
Yeah, and just to remind people listening in that the report will be sent out following this event. Jonathan, any final thoughts from you?
Very little from me, but say thank you all for listening and for giving us the opportunity. For those interested in investing in sustainable energy, at Guinness here we run a fund. Do take a look. It's a very good fund. I believe also that the Schroders fund is very good as well. So I'll hand over to Mark.
You can tell we work together, can't you? No, but I will say it's been a pleasure. As I say, a huge amount of respect for Juliet and obviously Jonathan. So thank you very much for your time today. I think the key conclusion from the report, I think the report's a little bit more valid than the IEA report, which I think is a little bit me too, in terms of let's just put down what we read from everywhere else. I think the thing to take away for everyone is if we get this right, it is an unbelievable investment opportunity, because you don't normally get cycles like this. It's a structural shift in the energy system. We've never gone through this before in our lifetime, apart from the adoption of obviously oil and gas into the energy mix. So it's a bit like the internet in 1999. It's the old Bill Gates thing. Things are overestimated in the short term, but massively underestimated in the long term in terms of impact. And this is where we are in the energy system right now. So I'll leave it there and say thank you very much for everyone's time, as always.
Thank you, Mark. Rhys.
Adam, no, simply to say thank you for having me on, and maybe I'll just reiterate the point I made at the start. I think the report really highlights the need to build on these strong foundations around social and risk management when it relates to sustainability and ESG, and move now to really supporting the enablers of the transition, because the time is now.
Right, absolutely. Guy.
Yeah, just a couple of points. I mean, I just iterate the point of scale that Mark made. I mean, every time we do these scenarios, you actually look at the numbers and you just go, God, do we really believe it? I think Jonathan made that point about, do actually people believe that this can work? So, incredible opportunity, but it has to be realized. I think the final point I'd say is that consumer-facing end, that demand end, whether it's flexibility or heating services or EV integration, etc. Whoever can crack that model, that is both a huge market in the UK, but internationally, I think is going to be important. And can you make it scalable rather than kind of bespoke at the moment? I think the role of tech and digital tech in that is incredibly exciting, and no one is quite there on it yet.
Great. Well, thank you very much. Thank you, panelists. Thank you, Juliet, and Good Energy for the report itself. Thank you, Radnor, for hosting the event. And thank you, everybody, for listening. Thanks very much.